So today we're going to continue with our finance conversation, and we're going to discuss what money is and how the financial system works in a broad manner. Okay, so let's start by talking about, what we're discussing. We're talking about finance, which is basically the part of the business that deals with how money is actually managed both by individuals and companies, right? So that's what we're going to be discussing. Now, what is money? Money is basically anything that is generally accepted by the public to acquire either goods or services. Now, usually when we're talking about money in the US, we're talking about dollars. But you need to realize that in the old days, this exchange of goods and services didn't happen with money. They actually happen in a barter system where you will exchange one good for another, or one good for a service and one service for a good, right? Now, the difficulty of the barter system is coming up with comparable value items, right? So if I have different things that I have access to, or that are my own property, when I'm trying to get something from somebody else, I need to find something that they are A, interested in, and B, that it's of comparable value to the one thing that I want to get from them, right? So exchanges are difficult when there is no physical money, and the reason why is because money, by creating a numeric system that breaks down value into smaller units, it enables me to pay the right amount for the good or the service, because money can actually be broken down, and B, and more importantly, when money is actually functioning properly, everybody will be willing to accept it because they know they can use it to exchange that money for other goods and services. So I don't need to find somebody who is interested in, let's say that I made some cookies at home. I don't need to find somebody that is interested in cookies so that I can get, I don't know, for example, if I want to get some toilet paper, which seems to be a hot commodity nowadays, right? I need to find somebody who is interested in trading one thing for the other. But if money is involved, it's a lot easier, right? Because everybody knows that they can take that money and get the good or service that they actually want. Now, in the current system that we are functioning in, money has fiat value, which means that it's just the fact that everybody will accept it is what makes it worthwhile. There is no actual value underneath the money. You used to have a gold standard, which was when the government will basically guarantee the value of the money by having gold that you could exchange for. So you could actually go to the Federal Reserve in the past, and you could exchange your money for gold, and they have money that you could actually, gold that you could take for it. And there is no gold backing the money at this point. It's all a system that works by me trusting that you will actually take the money. This is why it's called fiat, because it's based on trust. Now, why is money useful? I think everybody knows most of this, but let me just talk about the functions. The most important probably aspect of money I've already discussed is that it's used as a medium of exchange. Money is used to help with the exchange because you don't need to find items of comparable value. Like in the case of barter, you just use money as a unit of value, and because of that you can actually exchange it for anything and then take that money and get anything else in exchange for it. Of course, so long as both parties agree, but it's basically facilitating that exchange by the reasons that I just outlined in the previous slide. It can also be used as a measure of value. So if now you want to determine how valuable any asset is, you can use money to do that. So not only it helps with the exchange process, but it also enables you to value different assets, from goods or services to things like stocks. And finally, you can use money to store value, right? So you can put a large amount of money, like, I don't know, you can hide it somewhere in the house, right? And that money is something valuable that you will be able to use at a later time. So you can actually take that value that you have created somehow, maybe because you're a very talented basketball player, right? And you've made a bunch of money. Now you can actually store that value and use it at a later time. So these are the three key functions of money. Now, for money to work properly in the system, it needs to have different characteristics. So let's go through each of them. The first one is acceptability, probably the most important characteristic for money to actually be functioning, which is that everybody in the economy should be willing to accept money in exchange for their products. If this condition doesn't met, the whole idea of money as an exchange mechanism falls apart. So everybody needs to be willing to take the money for the products and services that they're trying to exchange in the marketplace. Two, the money needs to be divisible. Maybe not infinitely, but divisible enough that will enable to value things accurately in the marketplace. So you can take $1 in our case in the US, and you can do the same thing with euros or yens or any other currency, and you can break it down further to make sure that you can assess value to a pretty high degree of accuracy. So we take down the dollar and we break it down into cents, right? So that enables us to create a lot of transactions, even though the items that we are transacting have a small value, and the accuracy that enables us is pretty high. Now, in the US, you cannot break down cents any further, but as you can imagine, you could actually come up with a system where you could go to a higher degree of accuracy. But in our case, because $1 is not worth that much money, it will not be worthwhile within the system. Okay, so we have divisibility. Second thing is portability. It needs to be something that is easy to carry. Right? This is not a problem with the kind of money we use right now, especially with bills, because they are light and you can actually put them in places easily. But when money was made of precious metals like gold and silver, portability was an issue because carrying large amounts of money is actually heavy, right? Of course, if you're talking about really large amounts of money, even paper is a problem, right? So about 1,000 bills. So that you have an idea, it's about 2 pounds of weight, right? So, I mean, eventually everything gets cumbersome, but it's pretty portable, right? Stability, it means that the value of the currency over time needs to stay stable. If there is no trust that you're going to be able to exchange this money for similar amounts of value in the marketplace over time, you create a lot of trust issues, right? People will not be willing to use their currency. In fact, there are a lot of countries that have high inflation rates where what they do is instead of using their currency, you can see this in some South American countries, they actually use dollars. And the reason why they do that is because the value of dollars is stable over time. So stability is a desirable property of money. Durability means that as you use the money over time in multiple transactions, it doesn't just fall apart. In fact, bills are not made of paper, they are made of a cotton blend, and this is why you can actually wash money, and if you don't do it in a very rough manner, the integrity of the bill will actually be maintained. So the money needs to be durable. There are some stories on that with coins, but we're not going to get into that. And then finally, it needs to be hard to counterfeit. This is particularly important if the currency that you are exchanging is of high value. So this is why you will see that there are a lot of new measures that are put in place, especially on high dollar bills, to try to prevent people from just counterfeiting money. The reason why is because if you cannot trust that the money that is in the system is indeed authentic, and counterfeiting is easy, it basically makes some of the other conditions not hold. So acceptability will fall apart, stability of value, etc. So to avoid those, we have all sort of counterfeiting systems set in place that make using a printer at home to print money a lot more difficult. Now, what kind of money do we have in the current society? There are different types of money, right? The most basic version of that, it's the currency that it's basically bills and coins. I think everybody knows that, so it's not a surprise. We talk about money in a more broad sense than just those, which everybody knows, right? The next level that we also consider money is checking accounts. So when you get paid, right, if you have a job, hopefully you have a job or you're thinking about getting one, you probably will deposit your money into a checking account. And the characteristic of checking account is that it's fairly liquid. What I mean by that is that you can transform that number that you have in your account into something that you can use for exchange quickly. And the traditional mechanism that you use for this is a check. So what makes a checking account is that there are not a lot of restrictions in terms of withdrawing the money from that checking account, and that you can use checks for payments of anything that you're transacting into the marketplace. The next step in terms of money is savings accounts, also known as time deposits. Now, saving accounts are usually less liquid than checking accounts. And what I mean by liquidity is how easily it can be transformed into paper, money, or coins, or used in the marketplace. So usually savings accounts have some restrictions on the withdrawal that you can actually make from them. Right, so they might have some restrictions in how early you can withdraw the money since you actually deposited on it, and they might have some restrictions in the sense that they cannot be used directly in the marketplace, so there are no checks that will actually be written against those accounts. So they are a little bit less liquid, although still considered money. Okay. Then you have money market accounts, which are typically similar to checking accounts, but they have more restrictions imposed on them. So you can still use them for transactions in the marketplace. So you might have a debit card that charges against them, or you might even have checks that go against them, but they usually have more restrictions. One of the typical restrictions on money market accounts is that the bank will require a really large balance on those accounts. So if you don't have enough money on the money market account, they will basically give you either a penalty or change those funds from a money market account to a checking account. Okay. So, and another characteristic of these accounts, other than the restrictions, is that you usually earn some return on the balance in those accounts. So the bank will pay you money for the funds that you have in money market accounts if you fulfill the restrictions that need to be met for that money market account to be created, which is usually a high deposit and a high balance. Then next we have certificate of deposits. These are similar to savings accounts, but they are even less liquid, right? So these are basically a financial instrument that is used that is equivalent to a short-term loan. Certificates of deposits can be issued by different institutions. So banks will actually give you a chance to buy this, but they have even more restrictions imposed in when you can actually cash these certificates of deposits. They usually have a maturity when the deposit can be turned into a cash. This could be something like 3 months, could be 6 months or a year. And what they will do as a counterpart for the fact that they are not very liquid, you cannot use it just on a whim. After you buy the certificate of deposit, they will give you a return or an interest on the money that you are paying them. So instead of giving you whatever you put in the certificate of deposit, they will give you that plus the return that is agreed upon from the beginning. Okay. Then you have credit cards. Right? What will be today's life without credit cards? I don't know. Right? So credit cards is basically a form of credit that it's agreed upon with a financial institution, usually a bank or a credit card issuer, right? And where the main credit card issuers in the US, actually worldwide, they are Visa, MasterCard, American Express, and Discover, right? So the idea of credit cards is that you have a certain amount of credit that you have agreed upon from the beginning. That's your maximum credit, and up to that amount you can just draw from that credit without having to ask for further permission. There is a physical credit card that goes associated with it, so any payments that you charge to that card will be placed against your credit, and unless you return that money, you will have a cap in how much you can actually charge against that, and you will be required to pay a certain amount every month. And if you don't pay, you'll get some fees plus additional interest from that money that you owe and that you have not paid back. Now, the reason why credit cards are very popular is because they make transactions easy. You don't need to write checks like you have to do from a checking account. Plus, if you're tight on money, they give you some flexibility because they enable you to charge higher quantities than you will be able to get from a checking account otherwise. And there are different varieties of credit cards. I'm sure everybody knows this. One type that is very popular is cards that will give you a return on your spending. So they will give you either points that you can transact for upgrades, for example, in planes or other goods or services. So you can actually get presents, or you might be able to apply those points against charges in other retailers like Amazon, for example. And finally, there are some that will give you actual money. So they will give you maybe a 1% or 1.5% if it's a very generous card, back of whatever amount of money that you have spent. Of course, the catch is if you don't pay all the balances in full every month, you'll be paying the credit card a lot more money than what they give you from using that card in each transaction. Okay. Yeah. Credit cards actually can create very negative and very difficult situations, and to limit some of the practices that were not very forthcoming in the industry. In 2009, there was a set of laws that were actually passed to basically limit some of the practices that were done in the industry to basically make more money for the credit card companies without having much recourse at the time by people that were using the credit cards as it was. Now, other types of financial assets and tools that can be used. Debit cards, now probably everybody knows what they are, but just in case, they are similar to a credit card in physical form, but they work very differently. They do not grant you any credit, and because of that, any transaction that you do in the moment, it will be checked against what your balance is in your checking account. So usually debit cards will be linked to a to a checking account, and if you don't have the funds in the checking account at the time of the transaction will be denied. Unlike in the case of the credit card, where if you are under your credit line, even if you don't have the money, you can still get the credit, right? So it works more like a check, although it's more convenient. Then you have other financial instruments that are maybe less popular. They are considered near money, for example, traveler's checks, money orders, and cashier's checks. They are used maybe for special occasions, obviously traveler's checks when you're going to other countries. Money orders are often used by people that actually don't have access to credit cards or debit cards, or they want to make a payment to somebody who doesn't have a checking account, right? And they cannot transfer money directly. And cashier's checks are used in many different transactions, especially with people that have, let's say, lower levels of trust with you. A cashier's check, it's accepted probably in most places as money, and the reason why is because the institution that is backing the check is not like a personal check, which is depending on whether you actually have funds in the account. It's cashier's checks are backed by the financial institution, and odds are the financial institution will be able to make the payment, so they are considered pretty much money. Okay, and finally, one of the recent digital revolutions has been this idea of cryptocurrency, and these work a little bit different than traditional money, in the sense that there is no physical bills or coins that are created. So it's completely a digital form of money. Now, having said that, most of the transactions nowadays in the US economy are digital anyway. There is not a lot of exchange of actual bills and coins compared to what was the economy 20 or 30 years ago, where a lot more of the payments were actually done with physical money. So digital transactions are nothing new, but Bitcoin and cryptocurrencies in general, Bitcoin is a special company, or a special type of cryptocurrency. They are uniquely done using digital transactions, so there is no physical money at all. Now, cryptocurrencies were enabled by a technology that is called blockchain, which is sort of fascinating. And if you're interested in new technology that could have a big impact in the future. I think blockchain is an interesting technology. It's basically something along the lines of ensuring security on the transaction system, and the reason why it's very secure is because every computer that is part of the network has the entire set of transactions, so it's very hard for anybody to try to hack or break down the chain. So because of that, it increases the security of any exchanges with Bitcoin to a degree that, at least at this point, it cannot be broken down. We'll see what happens with quantum computers. But a lot of this safety technology is starting to be implemented not only for cryptocurrencies but for other issues. So if you're into computer science, I think there is a whole host of applications that this kind of technology can also have. Now, when you're talking about finances in the United States, the most important institution on the financial system is the Federal Reserve. So let's talk a little bit about the Federal Reserve. The Federal Reserve, it's basically in charge of making sure that the financial institutions within the United States and finances work properly, right? So it's essentially in charge of most financial matters within the United States. It's an independent agency that it's elected separately than the executive branch. So it's not, their policy is not dictated by the president or the Senate or the House of Representatives, right? So it's actually independent, at least in theory, right? We can argue about this, but the law says that it's supposed to be independent. It was established right before the Big Depression, so at the beginning of the 20th century, and its whole charter is to regulate the banking and financial system. Okay, so they are the ones that set a lot of the rules and regulations for anything that has to do with finance. Now, what are the main functions of the Federal Reserve Board, also known as the Fed? Well, first, economists maybe will say one of the most important functions is to determine the monetary policy of the country. Monetary policy basically dictates the amount of supply of money that is available for everybody who operates within the economy. Okay, so it's going to determine monetary policy. We're going to talk about how, and I'm going to show you graphically how some of these effects actually work. So it's going to determine the amount of money in the system. Two, it regulates banks and other financial institutions. So it's going to determine, for example, what are the minimum reserves that banks need to actually hold in place to be able to operate. And there are some restrictions on that, because otherwise banks might be tempted to loan too much money and then not have sufficient funds to face payments that may actually have in the future, right? So there are some regulations that they actually dictate. Third, they are in charge of check clearing procedures. So we've already talked about checking accounts, and checking accounts, they are extremely prevalent. And anytime checks are issued, the Federal Reserve is in charge of all the procedures that are actually done for clearing those checks, making sure that the system is working appropriately. And then last but not the least, for all us small people who have deposits in any banks, the Federal Reserve regulates and supervises the Federal Deposit Insurance Program, which, I don't know if you know, but all the funds that you deposit in a bank, up to $250,000 are insured. So even if anything happens to the bank, specifically the bank that you're banking with or the banking system, there is an insurance that will actually back up your deposits in the banking system up to $250,000. If you're lucky enough to have more than that, that will not be covered by this insurance program that the Fed is in charge of. Now, let's discuss a little bit in more detail what we mean by some of these things. So what is monetary policy? Like I already mentioned, monetary policies essentially determine the amount of money that is available within the US economy. In our case, I'm talking about the Fed, right? Now, Europe has their own equivalent to the Fed. It's called the European Bank. Actually, Europe works a little bit differently because even though there is a European bank, there are also equivalents to the Fed at each national level. So there is a slightly more complex system. So let's talk about the Fed. But there are equivalents to the Feds in other countries as well. So they determine the supply of money essentially. And how do they do that? Well, they're going to have different monetary tools at their disposal, and we're going to discuss some of them next. Now, the reason why you change the amount of money available in the system is because you're trying to manage inflation. Inflation is something that could actually create trouble for the economy, right? If you have really high levels of inflation, that's going to basically limit how much the economy can actually grow. Large inflation amount is basically usually happening because there is a growth rate that it's actually not sustainable. Or you could have the opposite. You could have a situation where you have deflation, which is actually even more dangerous for the economy than inflation, which is when prices are dropping, right? Actually, you can see a little bit of that happening with gasoline now, but I think the reasons are different than just deflation. Now, when there is deflation, it's at a general level. It's not just one good that's dropping prices. It's just all the goods in the economy overall. And when that happens, everybody basically waits to not buy anything because they know the price is going to drop. And that creates a very pervasive cycle. So the Fed tries to limit this deleterious effects of inflation and deflation by changing the supply of money. You can actually change the supply of money and then you will get more or less inflation. We'll talk about that in some diagrams next. Okay. Now, how do we know how much money is there in the system? Well, there are different metrics that are actually used for this manner, right? And each of the metrics has a funny name, starts with an M. I think M for monetary supply. And there is M0, which is not in this slide, which is basically all coins and bills in the system. That's the M0. Then you have M1, which is coins and bills plus all checking accounts. Okay. Remember, we were talking before about what money was. There are different financial assets that are considered money. And what we're going to do is we're going to have different metrics of money supply depending on what you're considering money. And what we're going to do is we're going to, little by little, keep adding financial assets that are slightly less liquid to what will be traditional money supply, which is just bills and coins, right? So M0 is just bills and coins. M1 is bills and coins plus checking account balances, right? M2 is again M1, so money, coins, and checking accounts, plus assets that are considered near money. So this includes saving accounts, money market accounts, and CDs or certificates of deposit. That will be M2. Of course, M2 is always going to be larger than M1 because M2 contains M1. And M1 is always going to be larger than M0, right? So I'm assuming everybody notices that, right? Because you cannot have a negative amount of any of these things, right? Then you have M3, which is basically M2 again, plus large time deposits, right? So these are basically what's considered institutional money market accounts and short-term purchase agreements. So oftentimes firms will have an agreement established with another firm, so a contract that they have signed, and they will use this agreement to get some funds from the bank. It's kind of like a warranty, right? Is what they are using as proof that, you know, eventually they'll be able to face payments. So those short-term repurchase agreements are considered also money. Although of course it has more restrictions because somebody needs to pay for them, but because they have legal binding, they are considered financial assets that eventually will be cashable, hence they are part of M3. And then you have M4, which is all the financial assets we have discussed so far, plus T-bills. T-bills are treasury bills, and these are short-term debt that is issued by the US government. So the treasury of the US is backing up this short-term debt, and they are traded every day in really large amounts. So arguably, it's probably more liquid than some of the assets that are included before this, but they are considered less liquid because of their nature. They are essentially short-term bonds issued by the US Treasury. So how can the Fed change the money supply? They have different tools at their disposal. First, they are in control of the printing press and the coin minting machines for the US, right? So they can physically print more money, and by doing that, they will be actually increasing the money supply, right? Because they will be increasing M0, okay? But they have other tools at their disposal other than just printing more money, okay? Tool number one, they can do what is known as open market operations. These are very common. In fact, the Fed engages in these kind of operations almost on a daily basis, if not daily basis. And what they do is they either buy or sell, depending what they are trying to achieve, buy or sell T-bills, okay? Now, how this works is if they buy T-bills, right? They're buying T-bills from private citizens or financial institutions that are holding them because they did buy them at some time, right? When they buy T-bills, what they are doing is they are giving private citizens money, and they are basically keeping the T-bill. So by doing this, they are increasing the money supply in the system, okay? Contrary to that, if they sell T-bills, what they are doing is they are removing money from the system because you have to pay them in order to hold those T-bills, right? Of course, these open market operations affect some of the M's, but not all of them, right? If you think about M4, what comes out of one side ends up in the other. So if you're measuring money supply as M4, open market operations don't have an obvious effect on it. But if you're looking at M0, M1, M2, or M3, they do impact any of those measures of money supply. So hence they do affect it to some degree. Okay, then you have reserve requirements. So the Fed can determine what is the minimum amount required for the banks to maintain for all the assets that they have available in reserve. And what this is going to do is it's going to limit the amount of money that they can loan to their clients or the firms that operate with them. Okay, and by doing this, if you increase the reserve, there's going to be less money in the whole system to be used through loans by these financial institutions. So changing the reserve requirements also can have an impact on the amount of money in the whole economy. Okay, they can also change the discount rate, right? The discount rate is the amount of money that the Fed will charge from banks. So you and I cannot use this, but banks can get loans from the Federal Reserve. So if you're a bank like Citibank, for example, you can go to the Federal Reserve and say, hey, I need 100 million to make more loans. Okay, the Fed will be like, okay, fine. We're going to charge you a certain interest like everybody else for those loans. Okay, and we call that interest the discount rate. Okay, and the discount rate is also going to have an impact in the monetary supply. The lower the discount rate is, the more money the more money banks are going to ask from the Feds, because obviously they are going to be cheaper to obtain, and then they can turn around and loan that money to citizens like you and me or businesses. Okay, so lowering the discount rate is essentially going to expand the amount of money that is in the system overall. Okay, you can do the opposite by increasing it, right? And by the way, now the discount rate is pretty close to zero, in case you're wondering. And so if you account for inflation, right now the Fed is loaning money to banks at a negative rate, which means that it's essentially paying them to take loans and trying to inject more liquidity into the system, hoping that it's going to help with the different economic situation that we have. And then another thing that the Fed can do is impose credit controls, right? So the rules by which banks provide loans to companies and private citizens have a set of rules that need to be adhered to, and the Fed can make those rules more restrictive, right? And by that can limit the amount of money into the system. So here you have the tools that I've discussed and what effect they actually have on the money supply. So if the Fed buys T-bills, right, what's going to happen is the money supply is going to increase, right, because it's going to be pouring liquidity into the system. So for them to buy those T-bills from the public or from the banks, it's going to have to pay us with money, maybe printing more money, right? Two, selling government securities, obviously T-bills, will have the opposite effect. It will basically decrease the money supply. Okay, if they increase the discount rate, right, that will basically make the money supply decrease because it will be more expensive to actually to get loans from the Federal Reserve. Hence, banks will have less money at their disposal, and that will basically reduce the money supply in the system, which will tend to slow down the economy, okay, and hopefully bring the inflation into lower values as well, if inflation was the reason why they actually did this, right? You can lower the discount rate with the opposite effect. You can increase the reserve requirements, and that will basically make also have less money into the system. The money supply will go down, and that will basically also make the economy slow down. If they decrease the reserve requirements, the opposite will happen. There will be more liquidity injected into the system, and because of that, the economy will tend to speed up the pace. Okay, so more loans will be available for companies, and because of that, more economic activity will ensue usually. Okay, and then they can relax or restrict the credit controls. If they relax the credit controls, there's going to be more liquidity into the system. People are going to have an easier time accessing loans, and because of that, there's going to be more economic activity, and usually you have the economy moving forward. And the opposite if you restrict credit. Within the financial system, one of the most important aspects are banks. There are different types of banks. You have commercial banks, which are the most common institutions that you actually find for banking, relied mostly on checking and savings accounts. They make loans to both businesses and individuals, and that's how they make the money from the interest that they charge on those loans. And what they traditionally use is they use the checking and savings accounts to basically fund those loans. So they create a pool of money and then loan against that. Okay. Then you have savings and loan associations, which are similar to banks, but they usually focus on long-term goals for residential mortgages. These usually are created initially because people needed financing for buying homes, so more than for business purposes. So this is usually for individuals. And in some cases, what you will find is that they have merged, and now that they are part of a commercial bank. You have also credit unions, which are actually owned and controlled by the actual clients of the banks, the depositors, the ones that are putting the money in their checking and savings accounts. Usually they have some sort of common employer or profession. So there is one, for example, for the military, right, where for you to be able to have access to the credit union, you actually need to be either a service member or a veteran to qualify, or be part of a family with somebody that is. Okay, and you also have mutual saving banks, which are similar to savings and loan associations, but they actually have a different ownership model where they are owned by the clients themselves, right? So it's also focused mostly on mortgages and long-term lending to clients, and they have a very similar structure to what a savings and loan would be. And they are not common across the US, and most of them are actually found in New England.